Analysts are bullish on Netflix, but investors aren't on the same page today as the stock sinks on a weaker than expected outlook. But the streaming giant continued to tout its dedication to revenue acceleration, calling it a, quote, primary objective on its earnings call. Yahoo Finance's Alexandra Canal listened to that call, and she joins us now for a vibe check. Hey, Ali.
Hi, Rochelle. I'm going to get right into it. My vibe check, neutral. Not too hot, but also not too cold. And that's mainly due to what we heard on this earnings call, which talked a lot about the future, right? With revenue initiatives like the password sharing crackdown and the ad tier not fully priced in yet. Netflix executives said it's going to take a few quarters to see the full impact of these initiatives. And I think that's largely what's contributing to the stock declines that we're seeing today. Shares are down another 9% this morning, and that's on top of shares falling 8% yesterday on the heels of that earnings report. Netflix did miss revenue estimates. They also guided to lower Q3 revenue. However, by and large, it was a pretty solid report, especially since some of those profitability metrics like operating margin and free cash flow came in steadily above expectations. And if you think about the media environment that we're in right now with not one, but two strikes in Hollywood, that's a good sign. Ted Sarandos, he's the co-CEO of Netflix. He was immediately asked about the Hollywood double strike on that earnings call last night. Here's more of what he had to say.
So you should know that nobody here, nobody within the AMPTP, and I'm sure nobody at SAG or nobody at the WGA took any of this lightly. But we've got a lot of work to do. There are a handful of complicated issues. We're super committed to getting to an agreement as soon as possible, one that's equitable, and one that enables the industry and everybody in it to move forward into the future.
So Netflix clearly looking for a deal. We've heard from some analysts that say at least in the short term, the strike could actually help Netflix. And in fact, the company did boost its full year outlook for free cash flow to $5 billion. That's up from the prior $3.5 billion, specifically citing the strike. But clearly from Sarandos's comments, it's not something that they want to see continue. And that brings me to my top takeaways from the call, because besides the strike, there was a few other commentary that I want to point out. Also, revenue acceleration. That is the primary objective for this company. It's going to be driven by the password crackdown and the ad tier. But like I said, that is going to take time to mature, and investors are going to have to be patient. And I'll quote Wells Fargo analyst Steve Kehall, who earlier this morning released a note and said, patience is a virtue, especially for those long-term Netflix investors. Another thing I want to point out is M&A. Netflix said it really wants to just keep producing content, not necessarily be a buyer. However, it would consider M&A if it's a strong IP. So a strong intellectual property is what Netflix said could spur some M&A activity there. So overall, neutral on the call, considering we still need time to see how all of this shakes out in terms of those revenue initiatives.
All right, so we've heard from Wall Street. What's the word on Main Street on this, though?
So Main Street, they're very keyed in to the strike. I want to pull up one tweet from a user that said, quote, with all those profits, these streaming services can afford to pay a living wage and provide health care to writers and actors. So interesting to see that investors are very aware of the strike and the impact it has on these actors and these writers. We heard from actor Sean Gunn yesterday on the afternoon show. He is well known for his roles in Gilmore Girls, along with Guardians of the Galaxy. And he said companies like Netflix and a lot of those legacy media companies, they're operating on an old model that's not accounting for streaming, especially with residuals being the number one issue that actors are fighting for. And then another tweet that I thought was interesting was calling out the high stock price that we've seen from Netflix over the past few months. This user writing, quote, revenue growth is only 2.7% year over year, similar to all previous earnings since the year 2020 that ranged between 2 and 5% year over year. This cannot justify the crazy stock price and 50 price to earnings ratio, but still not enough at all for the crazy stock price. So that's just something to call out when it comes to how some of these tech companies have been a bit overheated right now. If we take a look at a 6-month chart for Netflix, that's up about 40%. And then year to date, we're seeing that up even higher, roughly more than 45% there. So clearly a lot of runway here. So perhaps what's happening now in the market is somewhat of a correction. And I also think expectations were really high heading into this print.